Larry Fink, CEO of Blackrock, is not believing in this current rally. The stock market rally that has been supported by a potential stop of monetary tightening. Right? In the last meeting, the Federal Reserve did not raise rates anymore, meaning monetary tightening stops, meaning risk on assets could go up in price again. Now, in this interview over here, Larry Fink talks about the Fed policy. He talks about how he expects another 1% raise in the target rates. And I'm sure if that really was to happen, this would be a surprise for the market. A rate hike, or rather 4 rate hikes, right? We need 0.25% with every hike. It would definitely cause a sell-off in the stock market. Let's have a quick look at this interview section together.
Larry, as we look at the broader market here,
right.
We have come out of a bank crisis. I don't know, it was a mini
crisis,
fit or something like
that. A little
that.
mini
It didn't feel mini to the banks that went under, 3
Correct.
of them.
Yes.
But the very issues that put those banks under, whether it was bank management in relation to higher interest rates,
Correct.
have not gone away. Now we've got the roller coaster coming right at commercial real estate.
Yes.
Are there more banks that you foresee failing, whether they are the regionals? We just talked to David Rubenstein at the top of the show,
Sure.
and he thinks maybe in a couple of years we will see some of these go away.
We have 4,400 banks. We have more banks in the United States than any country in the world. We believe in local banks, so we have a strong foundational belief that local banks are good. But to have 4,400 maybe is too many. Liz, you framed it perfectly. I believe interest rates are going to continue to go higher. I think the Federal Reserve is going to have to do minimum of 2, but maybe as much as 4 more tightening.
4 more rate, 25 basis points.
25 basis points, another 100 basis points. I actually believe inflation is stickier and more structural. And so I see a future of higher interest rates. Higher interest rates is going to create more stress in commercial real estate. Mm-hmm. Commercial real estate is the largest asset category of regional banks. And so there may be stresses.
That's a problem.
But the first 3 banks did not have stress on credit. They had stress on their mismatch of their assets and liabilities.
4 more rate hikes, an increase of another percentage point because of sticky inflation that's systemic. I don't really see the sticky inflation. Of course, in the official numbers, we are still relatively high. We are at 4%. But if you look at the unofficial numbers, when we look at inflation rates that are calculated on daily new prices, so not just on random housing surveys, but on actual market data, we have a different number. We've got 2.33% of inflation. This is according to trueflation.com. It uses the same basket as the US government does. So same constituents, but the data is updated more frequently. The data sources are potentially more reliable. And so every day we get a new inflation estimate on Trueflation. And 2.3% doesn't look like bad sticky inflation to me, right? This is declining very, very constantly. 2.33% is not a problem at all. 4% would be. But even with 4%, I don't really see the room of another hike of another percentage point, because the target rate is currently at 5 to 5.25%. The official inflation rate is lower than that. And historically, when the inflation rate was lower than the interest rate, that tended to be the time when interest rates did not rise further. We simply just stayed at the level for a while. So I don't really know why the head of BlackRock is saying this. If there are other kinds of interests in the background that play a role here, I simply disagree with inflation being sticky. But let's discuss this together on Telegram. You can join us here at Bitcoin Strategy Channel. Simply search for this term within the Telegram app or click the link down below. Looking forward to chatting with you. Bye-bye.